Today's show is sponsored by Peak Housing REIT. To learn more, go to thepeak.group.
All right. Episode 56. Shannon Saccocia's here. Shannon, this is your second appearance with us?
Correct.
Can you just come on every month?
Yeah,
Do you mind?
Anytime you need me. Or want me, I should say. You certainly don't need me.
We want you to be on the show all the time. We need you to be on the show. For those who don't know Shannon or aren't familiar, we wrote a little intro for you this time. Shannon is the Chief Investment Officer at SVB Private and is a CNBC contributor.
SVB is?
Oh yeah, let's do that. Silicon Valley Bank.
Correct.
Merged with Boston Private,
Correct.
Which is where you were. Mm-hmm. And you are now the CIO of the whole thing.
I am.
You're a huge deal.
Woo!
You're a huge deal. And previous to that, you were the Director of Manager Search and Selection for Silverbridge Advisors, and you were an analyst at State Street. Did I miss anything major?
No, that's my whole life right there.
Okay. Pretty impressive stuff. So what's the biggest change since the merger of SVB and Boston Private? And I want you to be as honest as you can. I want you to really let it out.
I mean, my average client age declined by about 20 years.
Oh, because you have all the tech money.
Innovation economy.
Oh,
it's a completely different client base in terms of age, demographics, experience working with an advisor. I mean, we were talking about this before the show. For the most part, we're trying to work with clients who or historically who already had an advisor experience. For a lot of these clients, they've never worked with an advisor before.
It's their first money they've ever made.
Right. And, and that runs the gamut from people who are like, I'm not worried at all. I can continue to do more of this. And this is just the first liquidity event to this is, I don't know what to do with this.
Was Silicon Valley Bank managing money, like doing wealth management prior to the merger? They had financial advisors there?
It was small. It was a small RIA previously. Okay. Yeah.
Okay.
So
and you guys were a big advisory firm in addition to being a bank.
Correct.
So now the banks merged and the wealth management side's merged. And how many people are we talking about?
Yeah, I mean, we've got, I want to say just in kind of wealth management, it's a few hundred people, and
it's a big firm.
Yeah, so I mean, it's a big firm. We have a big reach. Obviously, the commercial bank, SVB Capital, SVB Securities, which is the old Leerink, investment bank. It's 4 pillars of a pretty substantial organization. But this focus on innovation economy is the biggest change, right? Because we had obviously had innovation economy clients, but SVB's really made their name as being the first stop, last stop for those types of businesses.
I remember, I think this is true. You probably know. I remember Silicon Valley Bank originally, we used to trade not with banks, the stock. It used to trade with the Nasdaq because they would take stock certificates in lieu of cash for payments for certain things. Is that true?
Yeah, that was the old model of just flexibility coming out of the .com.
They'd be like, all right, we'll be your banker. We know you don't have any money yet, but pay us in equity?
Yeah, essentially.
Genius.
Yeah. I mean, not as big a part of the business anymore, but if you think back that nascent part of the economy, we talk about the missing middle of banking. Nobody wanted to bank these companies back then. So, that was it. And then from startups to global funds, this big rise in VC and PE banking all of those funds. I mean, that's an incredible business.
Okay, so you're a big shot there now.
Yeah.
All right. Do you get to spend a lot of time on the West Coast for that? Are you flying or?
Yeah, I mean, I think from trying to grow our existing business, but really just grow the knowledge of the private bank. We're, a big newer part of the business in terms of our reach. So
what's a culture clash like Northern California and New England?
Oh, it's exactly the same.
Is it interesting? Okay.
Yeah, I mean, I think values-wise, not that different in terms of just client experience, but I mean, it's certainly different. I would say, from my perspective, the employee engagement's really high with SVB. So similarly to clients, right? Clients love being clients of SVB. We all hear that, but it's really true. And I think the employees really love being SVB employees. There's a lot of opportunity. So people have moved around a lot. You see a lot of people that have a decade, 15 years of experience doing different things as the company has grown. Mm-hmm. And so growth always affords opportunities to people, which I think is the most interesting part of getting to know the other employees of SVB is just how much they've grown with the company over the last 10 years.
Are you all remote?
Not all remote, but we have a lot of virtual employees because we hired a lot during the pandemic.
Yeah.
So but I like being in the office occasionally. I think it's great to collaborate. We've got offices here in New York, Boston, Miami. All the places where you would expect an innovation.
See how many people I have here today?
Yeah,
This is the most that I can remember having here.
I thought it was for me.
It's all for you. They all want to step to you and tell you how much money you lost them this year. So they're gonna line up that side.
Fantastic.
The Nasdaq bounced in the last let's call it 30 days.
Today too.
What was the low? June 13th or something?
16th, I believe.
Okay. Did anything specific happen on that day? There was a CPI
16th.
report.
Yeah, no, stocks stopped going down. I think that CPI report that we were talking about the other day, that was, I believe, on June 30th. No. That was it was July 13th. Am I right? I can't even remember. I'm looking at the chart. But anyway, nothing. There was no moment. There was no declaration. Okay, but there was enough. There's enough selling. It was done. It was enough.
I don't think those lows are going to hold. I hope they do.
Hang on, you're stealing my thunder. I was about to say that.
Well, all right. So
let's get into it.
So just starting with technicals, 4,100. There's a ton of congestion. That's that May area where we definitively broke down from. So let's see what happens if we approach 4,100 and we rip through it. Great. But for me, I feel like that's where things will get tricky. But maybe those June lows are tradable. Like maybe that's a bottom that we can bounce off of again.
Well, so there's definitely some good signs. So this is Jason Gebford, sentiment trader. He said the bear market is over, and he caveats the shit out of this. He's sort of doing this tongue in cheek, but it's true. In modern markets, so he's going back to, I believe, post 1960. The S&P 500 has never lost ground over the following year when advancing volume was 87%, which sounds cherry-picked, but he'll stipulates that, whatever. Or more of total volume for 2 out of 3 days coming off a 52-week low. So basically, in English, what that means is that we were at a 52-week low, and advancing volume was absolutely overwhelming to the upside. And this is the chart. You can't see it, listeners, but we will put this in the video and in the show notes. This is a pretty good track record.
After 2 to 3... After 2 or 3 days?
2 out of 3 up days. So 2 out of 3 days with more than 85% of New York Stock Exchange up volume within 30 days of a 52-week low. So big buying. This is not that convoluted, honestly. It's really not.
It's another way of saying a breadth thrust.
Yeah.
Which is a little bit more easier to understand.
Whatever. He quantifies it.
Okay. What do you think?
But well, I'll take the other side because it's 2 to 1 here. So,
okay.
No, I guess like my challenge is that I'm looking at it more from the macro perspective, and I'm trying to think of the catalyst for us to hit a new low.
Run out of sellers. That's the only one I can think of.
Run out of sellers to hit a new low.
Oh, to hit a new low.
Yeah.
What would have to get worse?
I think that most of what could get worse is. Look at the CPI parent, 9.1%.
I don't think that'll get worse.
That's not going to get worse. The Fed's not going to get worse. The Fed is seeing evidence that the work is being done for them.
Yeah.
Earnings,
fine.
We're fine. Mm-hmm. And if I look at what is expected, if we're talking about the Nasdaq,
are earnings fine? Do we have enough information to be able to say that?
So far, there's been no giant surprises to the downside.
What's interesting is that Apple is up big off its low.
Big.
Over the last week, though, it's analysts trimming estimates every day.
what's Amazon up?
So
a ton too.
Off the lows?
Yeah.
Oh, yeah.
Yeah.
Amazon looks like it put in a meaningful bottom.
Apple too. But here's where it can get worse. So I happen to agree, not to get like too crystal ball here. Obviously, that was tradable low, right? Like a bottom was in. The bottom, we'll see. A bottom was in.
Obvious only now.
Right, obviously only now, of course. So assuming that earnings continue to just be okay, right? Not terrible. I think that if we do go into the R word, it will start to show up a little bit later in the data. And you're starting to see more hiring talk, more slowing talk. So I think right now in the short term, market is looking past CPI peaking and ran out of sellers, and we're getting a rally.
So we're in an interlude between the end of the inflation scare, but it's a little while before, like, oh no, it's really a recession.
Right.
Well,
that's so bullish.
Well, it is, and so I look at it on the flip side of that. I would like to see 11 million job openings not be 11 million job openings, because I think that's a ludicrous number. None of those are ever going to get filled. And I think that they're...
I think it's a fake number.
Right. Well, we talked about this the last time I was on. We talked about like the inconsistency of reporting, and that hasn't gotten better over the pandemic period.
These are virtual jobs and not even like show-up jobs. I think they're fake.
Right. They're out there. Let's see if we get a hit type of thing. It's phishing. It's basically phishing for employees to see if they can pull somebody that they can get at a reasonable wage.
Hey, we have a baseball team. We have 8 players. We need a 9th right now. That's not what kind of jobs is 11 million jobs out there. No way.
No. So take that off the table. I think that's actually a positive we take it off the table, because I think it's diluting the actual narrative of what's happening here. And the actual narrative is I get asked about stagflation all the time. Wage growth is coming down. Wage growth is coming down. The stickiest part for margins is wages. We start to see wage growth coming down. And the commodity stuff is great because that hits PPI, it hits CPI, it hits the numbers, from a trailing perspective really quickly. I think the most important thing is wages are starting to normalize, and those job openings are going to come down. And all of these companies that keep warning us about margin, they're going to be able to actually pinpoint much better by the end of this year what their margins look like in the future. And that's where we're going to be able to look at earnings. And so I hear you on the recession thing. I just don't think we're set up for a sustained recession. There's no overheating except in asset prices. And hey, we've solved part of that problem. So I have trouble seeing again, I'm not going to argue whether this is the low, who
knows, right?
I don't know.
So can we go, housing is more important than the stock market. We learned this in
Whoa. Is it?
Yeah. Major.
From a wealth effect perspective.
No, major. It's for most people listening to this, the house is their main asset. And it's the primary determinant of how good they feel about their situation. Like, if they're in a bad situation housing wise because they're not able to make their payments, it materially changes their situation. So this is renters or homeowners. It's probably 15 to 18% of all economic activity revolves around the house. Like factoring in like lawyers and realtors and
materials,
renovation, like remodeling,
home goods, just
everything.
Yeah.
It's probably like a huge chunk of GDP.
And what's Restoration Hardware saying?
It's housing related. What's that?
Is Restoration Hardware optimistic?
No, the stock's been cut by its market cap by 2/3. Like, so I don't think it has to fall off the cliff to have a negative impact on the economy. So the question is like, what could get worse? Well, what could get worse is these high prices that are being held up by scarce inventory start to fall because the buyers just literally disappear. What would make the buyers disappear? If rent prices ease a little bit and wage pressure, to your point, eases a little bit, and people are just like, you know what, I'm good where I am right now. I'm not making any changes. I think home sellers are being inordinately rewarded for the scarcity that exists, and that won't continue if like things really normalize to the extent that you think they are.
I don't see that scarcity issue being solved anytime soon.
I agree.
Just from month over month, like the amount of months on inventory.
But the demand side could disappear. I agree with you.
What about people talking themselves into a recession, where you have CFOs and CEOs saying we're going to pull back, we're going to slow, and it becomes self-fulfilling, and we put ourselves into a recession. By the way, we've said this a million times. A recession doesn't need to be like an end of the world type recession. We could have a moderate. We could have a moderate recession.
We could have like a cute one, almost. Right? Like an adorable.
We could have it right now. I mean, that would be a cute one when you have a Q1 GDP decline that's net exports and inventories come back. This
Right. Everybody understands that. But we had Apple, Microsoft, and Google recently talking about slowing down. Initial jobless claims are, John, can you scroll down a little bit to throw this chart up? We're in like section 2, so sorry, I'm skipping around. But initial jobless claims ticked up to 250K this week, which is still low. But it looks like we're up. Here we go. Look, I mean, again, we're still very, very low. But my point is, we really haven't even.
What is this?
This is initial jobless claims.
Continuing claims are still like
very low.
Very low historically.
But I guess that's my point is all of this caution that we've seen coming out of earnings calls, not just this season, but last one, we haven't really seen anything much in the data yet. Well, we see, that's not true. We've seen PMI come down.
Why?
It's
If I'm
all
a
anecdotal,
CEO,
though.
why
You're
wouldn't
right.
why wouldn't I take that cover, just like the Fed? Why wouldn't I take the cover to be conservative right now? Why wouldn't I take the cover to say, hey, we're pulling back until we're sure that all of these things that you're warning us about, which is lower enterprise spend, which is this coming recession, which is buyers, the demand falling out of the bottom of the market. Why wouldn't I be conservative? I mean, to me, I think CEOs are being appropriately rewarded for being conservative, and I see no change in that over the next couple.
Bank stocks were.
Absolutely.
Charlie Munger said probably last year, if you're not confused about what's going on right now, then you don't understand it. So you had J.B. Hunt basically on a conference call say, I am seeing the CEO, it's like one of the biggest trucking companies. He's basically like, I am seeing absolutely no slowdown in demand for anything whatsoever.
Every bank CEO said that too.
And then like the CEO of Tesla is like, guaranteed recession. So like what do you even do? Like what do you even do with this level of disagreement amongst like business leaders? Because it's so...
You buy Bitcoin.
So anyway, I think a lot of quote unquote evidence of recession does not really exist. It's almost all anecdotal. And a lot of it is vibes. It's like feelings based. No, but really.
I know. I'm laughing because you're right. It's just...
there is no evidence of recession.
Right.
There is evidence of things that are making people feel like they're in a recession. And that evidence is...
Well, what about like gasoline prices? That makes people feel pretty shitty. I know we've come down a lot. I think it's like 38 straight days, by the way, or something crazy of lower gas prices. But it was not just gas prices. It was literally everything. And if you weren't paying more, you were waiting. And people really, really hate inflation in dollars and in
they're
time.
not stupid. They know that if their wage goes up 5%, but their cost of living goes up 14%, it's a personal recession.
Also, the wage gains are usually one time. They're a one-time increase, whereas when you go to the gas station again, I know they've come down. You don't buy it?
No, I do. First of all, I mean, the wage thing drives me crazy because we didn't have any wage growth for 15 years. So like, let's just factor that into margins and move on.
Moment.
Like, let's move on, okay?
Yeah.
Because we needed it, and we needed a reset here. I think from a perception, a confidence perspective, I don't disagree with you that everything feels more expensive, but I don't think the difference is I don't think demand's destructed. I think it's delayed. And so if we're looking at demand delay versus demand destruction, that's an entirely different story because you start to see the dispersion between consumer confidence and consumer spending. You're seeing it now. I don't get too excited about, we're back to 2019 consumer spending levels because, yeah, of course, we're paying more money. So, it's not like we're getting any more.
Yeah, nominal terms.
But wait,
great.
but real retail sales are still very, very strong.
But that's what I was going to say. Next point. Nice segue. Real retail sales are pretty strong. Again, factor out gas. Obviously, that's a big part of it. But I'm looking at historically that correlation between consumer confidence as a leading indicator for consumer spending it's terrible. Like the statistical significance of that is terrible. So you can feel all you want, but the delay in the demand actually I think would be positive for the economy. We had this huge surge of goods spending and a huge then rotation to services. Neither of those were ready. And you get all this pressure. A delay would be fantastic and would set up for a great 2023.
Well, we haven't spoken about the elephant in the room is the...
Don't talk about me like
the
that.
chance of...
I am the elephant in the room.
The chance of a policy mistake and the Fed just going too far.
Which one?
Pushing us into... Which one? Yeah.
They only do it every fucking time, but let's definitely not worry about it this time. I mean...
So for the first...
It only always happens.
For the first time since May 2018, from the Bank of America Global Fund Manager Survey, hawkish central bank rate hikes are the number one risk according to fund managers. But I guess to your point, Shannon, what is not being priced into the market right now? What is the risk that materializes that people are not already pricing in? I guess a policy mistake would be it if they go too far.
Taiwan. Like Taiwan Semi or Foxconn, both of which are in Taiwan, operating mostly China, Taiwan, like being inhibited because Apple can't do anything without Foxconn, and literally the globe would shut down without Taiwan Semi. These are the two most systemically important stocks to the U.S. stock market and economy, and neither one of them are based here. And I don't think that's like an imminent risk. I don't think China wants to destroy its own economy in the process. I'm just saying, like, people are like, what's a tail risk? That's a tail risk.
I think they're showing that they're willing to destroy their economy from a policy perspective with
so
zero COVID. So I actually think it's even more. I think it's. That's why I think you're right. That is a meaningful concern. The only thing that I think that will cause them pause is actually what's happening to Putin, and what
is happening to Putin? That's off the front page. I don't even think it's on the 5th page.
No, and it's because he cannot continue. Basically, he's given up every opportunity to have a sustainable economy going forward because of this move. He was already on that path from an isolationist perspective, but I think the Taiwan question actually is. I think it's broader than just Taiwan. I think it's.
Wait, hold on. Putin's selling oil in India now. He doesn't give a shit. He's fine.
And they have a bigger population than China now. Is it right up there?
And now he's gonna play games with them this fall when it gets cold out. And I think it's too early to say that Putin's like in any kind of like worse situation than he was in 3 months ago.
But can we just say that I just think the broader concern from a geopolitical perspective is that what we were talking about earlier about the fact that there's no sustainability in like geopolitical risk it doesn't matter. I think we're entering a new phase where it actually absolutely matters. But that's why I think about global versus isolationist policy, globalization versus isolationist policy, and how does that affect everything from a global economy perspective? Like, how does the rearmament of Germany change the political landscape? How does that actually change the trading landscape? What happens with Japan, which has basically been off the map from an economic perspective for decades, but is strategically important from a military perspective, should these risks continue to accelerate?
What does the end of just-in-time supply chain mean for multiples of stocks? Like, what does the end of just being able to order things from all over the world and have them arrive on time? What does the end of that mean for profit margins in the S&P 500?
Is that a J curve? Because then you have to expend all this CapEx to bring production closer to distribution. You hurt your margins in the short term, but does that create this additional sustainability in the global supply chain and for companies here in the U.S.? Do we become more strategically
How long before it becomes seen as a positive?
Right, and what does it mean that Elon converted 75% of his Bitcoin to fiat? We just don't know these things. What about the yield curve? Has that lost its signal? How much weight do you put on that?
I'll tell you in 3 months.
That is steeply negative.
It's screaming.
It's screaming recession.
Yeah.
It's now inverted twice, meaningfully.
Right.
20 basis point inversion 2 weeks ago.
Would you say that the dynamics of central bank policy, the yield curve, and the way that the bond market has been operating in the last 30 years are the same or different?
I would say that, and I said that in 19, and then COVID punched me in the head.
Yeah. So
I would have said that. I would have said, throw your yield curve out under 5% Fed funds rate, because it's not the same, signal that it was when there was like actual yield in the market.
Actual yield.
There's nuance here because companies gorged on borrowing in 2020, right? So they're good. They're like fat, flush with cash. But at what level do borrowing rates start to impact not just corporations, but people that are borrowing money on a daily basis, whether it's for homes or other things? Like, can this economy handle a 4% 10-year, 5% 10-year?
My opinion is
Congress
it can.
It can't fund the country.
But it can't. That's why there's a ceiling. That's why these people who are talking about 6%, 7%.
I don't know what they're talking about.
No, it's absolutely ludicrous. It's never going to get that high.
See, Duncan, we told you.
No. There's no possible way.
You can't pay the bills.
None of this works. None of this works in a situation where we're paying interest like that on the debt. It can't work.
I don't care how much they roll that balance sheet off. Like if you look at where we were in 2007 versus where we are today, I mean, that to me is your answer about the yield curve. The yield curve is going to be artificially held at a certain level because we are now Japan from a debt perspective. Look at the interest rate environment in Japan. Do you think that has anything to do with the economy? Do you think there's any correlation between the economy and the yields that are paid on JGBs? Absolutely not.
Well, what does a 4% 10-year mean for multiples? Like, what if we don't go into a recession and earnings are fine, but people are just like, you know what? There's more competition for my dollars. I'm going to allocate some more to bonds.
I think that's a reasonable expectation, and I think that's why you get the divergence of what you're seeing, the factors that are starting to show some meaningful outperformance. And you guys probably do a lot more factor analysis than I do, but I'm looking at cash in hand factors, dividend factors. I mean,
quality dividends.
Well, but we can look inside the stock market. Look at the massive bounce in home builders, for example. Maybe they're looking past peak interest rates, or peak sense kind of silly at just 3%. But
isn't that the same argument about why you want to buy energy now? Is because the housing market's undersupplied, energy market's undersupplied. So that's a 3, 4, 5 year play on what you need. I mean, home builders for me are. That's the firing line of your argument earlier, Josh, about the housing market. I like housing adjacent stuff because I think that's the softer way to play it.
Like what, Home Depot, stuff like that?
Yeah. But I think from a home building perspective, everyone's talking about the bull case for that is that even in a slightly higher mortgage rate environment, people are then going to start, instead of anchoring to 2.25%, what are they going to anchor to? 5.5%, 6%?
Rates look cheap.
At some point, you're going to anchor to a new level, and that demand, I think, comes back. And so
they're not gonna meet it though. The home builders do not.
You said they're not going to make it?
They're not going to meet the demand.
No, I agree with you. So
they will not
people
build.
think they will, but they won't.
Because they're not like, oh, we got to supply this housing market. They don't give a shit. They're not going to build and lose money on every house they sell. It's just never going to happen. So they're going to look much the same 10 years from now as they look today in terms of the amount of output and the margin that they're building toward. These are like for-profit businesses. They're not a piece of the macro in the same way that like WTI crude is.
Well, another reason to add to the confusion is that there's a lot of conflicting signals, but also a lot of the market just got wrecked. So home builders fell 40%. So maybe we already priced all. Like we just don't know. We don't know.
It might be enough.
Is that enough? Could be.
What do you think you talked about rents earlier? What stabilizes rent prices? Because we went from whipsawing between nobody is ever going to rent again in a top tier city to now like
New York City rent past $5,000 for a one bedroom.
Right. So
who's paying for that?
Here's the problem: the rents will stabilize. They'll stabilize at very high levels. Like they're not going to fluctuate up and down every year, just like people's salaries don't fluctuate. Like once you get to a place where this is what I make, that it doesn't go down the next year.
This is why consumer sentiment is in the toilet. Real world price volatility sucks. You accept that in the stock market. That's a contract that we all sign when we're investing.
Yeah.
You don't expect it to show up on a daily basis in your life.
And you don't even appreciate it if it drops because you know it's about to go back up. Like, so where do these things settle out? Or when they stabilize, will that be bullish? Tell me what level they stabilize at. Because what if the Fed signals that it's done enough and the rate of inflation slows meaningfully and then like gets back to their 2 or 3% target?
How long does it take?
Wait, no, that's not even the point. The point is that, okay, it stopped going up, but it's not going down. And all of these prices are now permanently elevated in our economy. That's the problem that I think people looking at day-to-day, oh, the market's rallying. The market must think it's priced in. You're out of your fucking mind. People a year from now are going to be still mad about the rent increase that they just went through. They don't get used to it that fast.
But I think that's why I keep telling people not to anchor to 2019 because you're right. Everything's reset.
You're right. That world's not coming back.
That world's not coming back. But what does this new world look like? And if we're anchoring ourselves to a new set of prices, does that lead to how long have you been saying that estimated returns on the equity market are going to be lower? How many years?
7 years.
Yeah. So, and we were wrong.
Literally.
Right?
Yeah.
So do we actually enter into this environment where all of those estimated returns that we all use in our financial planning software actually come to fruition? And do we get to a point where now we have to think about engineering growth in the actual economy?
Heaven forbid.
That's the real need.
Here is the new world. Things are not available at your fingertips just because you press enter in a computer. You wait for stuff. Car leases are so egregious and outrageous that people hold on to their cars for longer. Homes, while scarce, stop going up in price because the rate to borrow goes up so much that the consumer is just like, I would rather live in a box than take out a mortgage like that I know I can't even pay for. Like, that is the new world. Teenagers don't talk to each other. They do dances on a screen and share. Like, the new world is not great. People are not happy right now. The frustration is manifesting itself in, like, the judgment of Joe Biden, which I guess always happens. Joe Biden has nothing to do with the fact that United Kingdom inflation hit 9.4% this week. He's not also the president of the UK. But it doesn't matter. That's where you're seeing that dissatisfaction. It's just hard for me to understand what would have to happen for that to go away. If you tell me it's falling gasoline prices, I think that'll make people happy for 10 minutes.
Well, but the question is, what parts of the increasing in prices are sticking and what's not? So I think that
wages and rent.
Right, and which are the two big ones, because car prices will go down. I think you can see food prices go the other way. But the big ones are sticky.
And be careful about cheering for the prices that go down.
Why?
Why are they going down?
Well, hopefully
perception of demand is
well, hopefully it's supply meeting demand.
So now corporations, small businesses, large corporations, whatever you want to say, they're looking at retrenching consumer, looking at potential for falling sales and higher costs. In what environment is that good for stocks? Like in what point in history was that mix? Now the question is, was a 20% haircut for the S&P enough?
And a 30 for the Nasdaq, and a lot more.
I don't
for
know.
individual
We're gonna
stocks.
listen.
We'll find out.
If I knew, I wouldn't be talking about it. I'd be executing. I don't know. I just feel that if we get out of it this time and we're back at new highs in 3 months, that was way easier than I would imagine.
I'd be very surprised if that was the case. If that were the case.
Okay.
Much more surprised by new highs and new lows.
Let's go into this New York Stock Exchange 90% update.
It's the same thing. It's Bank of America quantifying the same thing that Jason did.
Show me these stocks trading near lows with the big rallies.
So this is a new feature on Y charts.
I'm embarrassed that I own one name on this
which
list.
is pretty neat. This is from yesterday. So
Shannon, did you ever see this on Y charts?
So they've got a stocks trading near lows list, and yesterday these names screamed: Carvana, Peloton, Coinbase, Affirm, Unity, all the biggest.
Carvana went up 20% on news that they got kicked out of the state of Illinois. So that probably
By
bottomed.
the way, these names are so blown up. Carvana could go up 40% in a day, and you wouldn't even see it on the chart. Honestly,
Peloton 17% rally, but it's back at 11.
dude. 17% rally. You can't even see it.
Coinbase 14% rally. Affirm, which is buy now, pay later. Unity, ChargePoint, which I own, which I've been destroyed in. Confluent. All right. So
these are flyers. These people are taking flyers.
Yeah, to me, what really matters is that Apple and Amazon put in like meaningful lows and then bounced hard. That's what.
Well,
that's what
we're
really
gonna hear from them next week, I think.
We're gonna hear from who?
the big
everybody.
Tech giants.
Big techs.
We've got Twitter on Friday. That'll be a debacle, I'm sure. You know what's interesting, Josh? Throw up that chart. Or you're not Josh. John, throw up this chart. So this is a CFO Optimism Index, and Derek Thompson has spoken a lot about this. It's this idea that people are optimistic about what's going on in their own life, but think everything is going to hell. CFOs too, apparently. We've got a chart showing the optimism about their own company versus the optimism about the economy, and the divergence is massive. In other words, CFOs are confident, reasonably confident, in fact, very confident that they're doing okay, but holy shit, you're all f***ed.
Well, this is a relative game. It's like, the whole economy is going to go down, but like because of my execution and guidance as an incredible manager, like my company will do better than yours. So again, we're not going to caveat this and say on our earnings call in our guidance, you know what, if the whole economy goes down, we're going to go up, but we're going to say we're going to do better than, our competitors who are clearly not as established.
So this index is saying that when they ask a CFO about if he's optimistic about his own company, that has barely fallen this year. But when they ask a CFO about their optimism about the overall economy, that has collapsed.
It's pretty bad.
So they're like, everyone else is screwed. I got this. We're good here.
But then isn't that going back to just what you said, Josh, which is like this real data versus sentiment? And
they're
seeing
all sentiment.
But Shannon you make a really good point, is that why wouldn't CEOs take the cover of what everybody else is saying and lower guidance, lower expectations?
I
Well,
would.
they might.
I would. I mean, why? I mean, I don't run anything. But
Why did Elon Musk turn 75% of his Bitcoin quote position
Cash
into
flow.
cash? Because he's saying recession every day on Twitter. That's what he thinks. So he did the smart thing. He's building up his cash. So like, if you think about next week, let's say you're Tim Cook, or any CEO of a large growth company, even if you think your numbers look great, you're exactly right, Shannon. Why wouldn't you sandbag and just buy yourself a little bit of breathing room for the next quarter, just in case? So now, will the market see through that bullshit? Shrug it off? Maybe.
It's everybody though. It's not
If
just
everyone
one.
does it-
It's not just one industry. It's not just one sector. It's everyone. And they're saying, despite the fact that we're seeing X, Y, and Z positive data, there's so much uncertainty out there. And I do think that at some point, as an investor, you do have to take a step back and say, okay, like, be that as it may, right? Like, who's actually providing solid guidance that I can bank on versus you're just trying to set yourself up for a beat?
Jerome Powell.
Yeah.
Yeah, but for the average investor, that's too much of a mind game to play.
But
And
the
it
average
just-
investor's not setting prices.
Yeah.
The point taken.
Let's do this at inflation versus wage growth, because this is really the heart of what I'm trying to say. John, we have these charts
because we
from
haven't
the
seen
journal.
we haven't seen real wage growth in a minute, right?
Think about a person who's living in this reality. Average weekly earnings have risen by 4.2% year over year. But when you adjust it for inflation, they've actually fallen by 4.4. Look at
That's pretty brutal.
this is fucking brutal. This is people's real lives. They might not statistically feel it to this extent, but they're like, man, I just gotta wait. I just gotta raise is the way they think about it. They don't think about it. I just got wage growth. I just got a raise, but
My rent's up 30%.
my landlord just and my health insurance and this and that and fill my car. They don't know that gasoline prices are down for the last 30 days. They just hear their friends talking about all of their higher expenses and they feel it. And that is what's contributing to an environment. You asked, can we talk ourselves into a recession?
Yeah.
Yeah, we really can. Because if you feel that way, how many iPhones are you buying next week? Like,
Actually, I was talking to a friend yesterday. We were talking about what do you think market, blah, 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 blah.
wait, I'm sorry. Let's just do one more while we're on the subject. This is also in the Wall Street Journal. This is change in June from a year earlier. This sucks. Everything about this is overall sales,
It's
groceries,
everything. It's
furniture,
everything.
cars and trucks, eating out, clothing, recreation.
But so Robin asked me, this is relevant, Josh, can we talk ourselves into
Yeah,
a
yeah.
recession? Robin, my wife, asked me, we're moving our baby, he's not a baby anymore, we're moving him out of his room into a different room, and that room is empty, and we're doing the closets, and the cost is outrageous. I said, we're gonna wait. What's the rush? He's not moving in, and I don't want to spend that much money in a closet. We'll wait. And my friend said to me, I'm the exact same thing. My wife is asking me for shades or whatever, and same thing. And so I think that we're not the only ones talking that way.
Put this last one up. Retail sales changed from February 2020. So same article.
But I'm still buying stocks. I'm still
Keep
buying
going.
stocks.
Keep going. Inflation adjusted retail sales are still strong.
Yeah.
Not as strong as they seem when you hear things in nominal dollar terms, which I think you made that point before. But they're still
But they're not
decent.
falling. People aren't. We're not. My point is, we're not even seeing the shit in the data with the consumer spending and the labor market, and that's the economy.
So can we go back to that first chart?
Josh, we're about to get schooled. I could see it.
Oh, I want it. I want it.
Okay. So, right. So when adjusted for inflation have fallen by this much.
Yeah.
So you made the point earlier.
Weekly
What's sticky?
earnings when adjusted
Earnings
for
are
inflation.
sticky.
Yeah.
We get back to inflation where it was. I don't think all of the price increases are going to be sticky. I don't, because I do think that to your point, we are going to see some parts of the economy see demand destruction, and then I think companies are going to have to right price. And so this to me is the persistent positive coming out of this. And this to me
That
is
it's
where
gonna reverse.
that it's going to reverse. Well, inflation's going to slow, but the wages are going to be sticky. And I would argue
That's a good point. Nobody's talking about that.
We're talking about this in
See how
terms
smart
of
she is?
so if you
I always said that.
if you go back and look, and this is a little weedy, but go with me here. So if you go back and you look at the way that the Fed looks at inflation, they use this PCE, and you look at the CPI. You know what the big difference is?
Owner's equivalent rent.
Right. And so that's been rising. It's been rising along with healthcare costs.
CPI
along with
has a
education.
higher housing component than PCE.
And so I would argue to you that yes, they're feeling those additional rent increases, but they were feeling rent, healthcare, and education costs rising for 10 years before
without the wage growth.
Right, without the wage growth.
Yeah,
and
fair.
so for me, I think that the stickiness in earnings is where we won't see that's not going to decline.
Okay, so you got to raise. Your cost of living went up faster than the raise. You're pissed off in 2022. What happens in 2023 when the demand is destroyed to some extent, things calm down, prices come down, but you still keep your wage?
Yeah.
That's when you get laid off.
By the way, this is fun, right? Like there's so many
Shannon,
things
that's
going
when you
on.
get laid off. That's what happens.
So here's what matters.
Right at that moment.
Inflation, interest rates, earnings, feelings, aka vibes. Shout out to Kyla Scanlon. That and there's a lot. It's a lot.
It is.
Let's go back to gasoline really quickly. Not only is it falling, the premium over U.S. crude was more than $60 a barrel at one point in June. It's now less than half of that. At the same time, retail fuel prices in the U.S., that's gas stations, have fallen for 37 consecutive days. That's a big deal. And Sean, my researcher for CNBC, pointed out that crude oil now is only 3% above where it was the day of the invasion.
That's wild. I think wheat is, and I think wheat is lower.
So that's what
wheat's
you know
down
what's amazing?
35% or something.
That's like the resiliency of markets is how quickly they adjust to new reality. Like we're not much higher than we were on the day Russia invaded Ukraine. So that whole thing about like it's priced in, maybe it is. So that's pretty impressive.
So I mean that begs the question of where do you think some of these prices settle out? Because that's when you actually start to be able to look at that from a stock market perspective, right? If I'm a airline and I'm trying to think about where do I anchor my jet fuel price
Because
at?
they got killed on gasoline.
Right. I mean,
or jet fuel, whatever it is.
But these expectations, of you guys remember the Goldman Sachs $200 a barrel oil call, right? In 2005, 2006, 2006.
8. Right at the top.
It was like late 6, early 7 because the commodities burst before the housing market did. And I remember thinking like that's a ridiculous call because we were starting to talk about like this slowdown in the economy. And so but someone asked me the other day, what's going to happen when oil goes back to $35 a barrel? And I was like, well, I don't think oil is going to go back to $35 a barrel. But do we really know, like, what level of demand destruction brings oil down to, say, $60 a barrel? Like, what is that, like, inflection point? And so, again, you're right. Commodity prices in general are reacting incredibly quickly to this perception of demand destruction. I think that at the end of the day, the number I'm looking at all the time, I'm looking at PPI every month because that's where I think that's where it starts. That's when you actually start to see.
Usually comes out the day after CPI.
The day after CPI, but I think that's more of a leading indicator of where we're going to be at the end of the year.
I'm
than
more of a
anything
beige
else.
book guy. I like a little color commentary. That, in fairness to Goldman about that late 2000s oil call, that was in the context of this belief that like the BRICS were going to like have this insatiable commodity demand and construction like out into infinity. And that was Goldman's thing. Like that guy, the guy that coined the term worked at Goldman.
Right.
A lot of what they were doing with commodities was extrapolating China, Brazil, Russia, just like their middle class becoming Americans. And of course, none of that happened.
So how does the flip side of that, when China doesn't grow this quarter but says they grow 1.5%, and they go from annualizing whether it's real or not 5.5% growth to what like we're doing? How does that impact the cyclicals?
Well, we're going to see all that in the numbers. Doesn't matter what they say because we were talking about this last week with Alex. The amount of revenue.
Yeah.
We'll see it.
Yeah.
Remember the chip shortage? So,
What, it's over?
yes.
Really?
In recent months, prices of memory chips used in many electronic gadgets have fallen. While semiconductors used in cars and data centers are still in high demand, some companies are preparing for sales slowdowns. TSMC, that's Taiwan Semi's top executive, acknowledged, however, that the broader industry is dealing with an inventory correction that has led customers to cut orders from some of its peers. Our peers, not us. After 2 years of pandemic-driven demand, quote, our expectation is for the excess inventory in the semiconductor supply chain to take a few quarters to rebalance to a healthier level. So double ordering of chips is now going to come home to roost. These stocks look terrible.
They had a huge bounce, though.
Yes, but look,
said
I mean,
everything.
the semiconductor stocks are in a no man's land. Historically, chip gluts don't take a few quarters; they take a few years.
Yeah, where's and so doesn't that, as the tip of that spear, where else has there been double ordering? Where else do you see? Because
We saw that in inventory at Target and Walmart.
exactly.
And all those companies.
So that's at the end. So there's a bunch of companies in the middle of semis and pillows.
Yeah.
That where that's another sort of factor that we need to think about, because
So potential tailwind if you're worried about inflation. If like a glut becomes apparent in all of these things, prices come down because retailers have to get rid of it.
right.
Okay.
And so then and I think but I think it's all along the supply chain, right? That's again, it's not just inputs and end
But
goods.
again, the problem is if we double ordered people and the employment picture that we think is so tight is not that tight, and there's just a shock amount of layoffs out of nowhere. And then they'll say it's bullish for stocks because the Fed's going to chill. And maybe that's true in
they
the
will
short
say
term.
that.
They will
say that.
I don't think the hiring has been nearly at the level that you would need to see significant layoffs. Again, I think where you see, and this is a little bit, if you read into the consumer confidence data, when people are asked about their current employment situation, they feel really great because there's plenty of labor mobility, right? There's a million jobs out there.
Yeah.
They could move their job. I actually don't think that we'll see significant layoffs. I just think that those 11 million openings just
That's what I think.
dissipate.
I don't think you have to have a crash in the labor market, but I think that there's a little bit of an illusion going on.
Those 11 million job openings or whatever it is, you're saying they're not real, and I tend to agree with you.
No, they're not real. Yeah. This sounds kind of alarming. AT&T fell the most in 20 years. This is on the open today. I think it got better. AT&T stock fell the most in 20 years after saying some customers are starting to put off paying their phone bills. AT&T fell as much as 11%.
It's down 8 now.
Their biggest slide since 2002.
That's alarming.
The rout erased the stock's gain for the year and sent phone company peers Verizon and T-Mobile lower.
What a junky stock this
Hold on,
is.
here's a quote. Quote, I'm not surprised to hear consumers are paying their bills more slowly. I am. They are already struggling with higher food and energy prices. Research analyst Peter Supino. Quote, I'm not worried so much for AT&T as I am for the broader consumer economy. You wonder if this is the canary in the coal mine, end quote. Shannon, ignore it?
No, I don't think you should ignore it. And I think
These
that
are not landlines. These are people's mobile phone bills.
Exactly. And to that point, you can't get a job. You can't interview for a job. You can't get anywhere without a phone.
Okay.
And so I actually think this is one of the more telling anecdotal things that is noted for me.
That's like a mess.
Right.
Okay. If that gets worse, we all have to pay attention to that.
Yeah, I mean, we talk about this idea
Auto loan
of
delinquencies and cell phones.
Discretionary spend, right? We all talk about like what's truly, it's like food, energy,
Netflix.
shelter, Netflix, right? Yeah. With ads. But I think that this is that second level. It's like, okay, you really can't do anything. Even if you're low income, you absolutely need to have a mobile phone, because in most cases you actually won't have a landline and you may not have housing security, but you have a phone, you can get to work, you can get where you need to get to.
So I think they had a $1 billion shortfall and they blamed it on collecting I think that's the number. Hold on. This is important.
Well, stocks are going out of the highs, by the way.
AT&T said Thursday it now expects 2022 free cash flow of $14 billion. That's versus 15. About $1 billion of the difference was tied to the timing of customer collections. The gloomier outlook overshadowed second quarter results that topped estimates for profit and wireless subscriber growth. So they're hitting their profit targets, but they're having trouble. They had a price increase, $6 a line on mobile plans.
If Verizon is going to say the same thing, there's no way that's company specific.
100% it can't be.
Yeah.
So who else?
Or if it is, then you'll see.
And how is that good
the
for
stock fall out of bed if Verizon doesn't report similar information?
So I'm guessing these aren't Apple users who can't afford their mobile phone bill for the most part. But how could that be like a good setup? So.
Well, I mean, especially on the services side, right? If you're thinking about sort of install base, and I mean that's to me, I look at this. I mean, AT&T's what are they paying dividend yield? Like 6%.
It's probably yeah.
Well, it's higher today, Shannon.
Yeah.
I don't know in the stock. I'm just asking because I'm looking at it in terms of you. This is
a
to
weekly
the point
chart.
Earlier.
This disgusting stock.
It's one of the worst stocks.
Execution. Yeah. It's about execution. So that's what I'm saying. Is this cover for we don't know how to collect our payments, or is this actually a trend?
That HBO thing, but then did it go so well?
It could be because that's been a shitty stock for years. So it could be cover. Let's do this phantom surge in trading thing.
Oh, this is so great. Did you read this article?
I did.
Explain to the audience what this phantom surge in trading means.
You know what? I don't need to explain. Let me just go straight to the article because I read this and I actually audibly laughed to myself. This is from the Wall Street Journal. A sudden surge in trading volumes in Class A shares of Warren Buffett's Berkshire Hathaway confounded investors last year. Okay, so let me interrupt myself. These things trade. What's the stock price? Is it $400,000 a share? Is it $100,000? It doesn't matter.
Yeah. This is the one that never splits.
The A shares. Yeah.
The A share.
So now we're looking at this chart of spiking volume, and you're like, what the hell is going on? Now a trio of academics say they have solved the stock market mystery. The jump in volumes was an illusion caused by a change in how Robinhood Markets Inc., Robinhood, reports fractional trades, according to a new study released Wednesday. I don't really need to read much more beyond that, but it's just incredible. It is just incredible.
So Robinhood was not correctly reporting the trades and making it seem like there was more volume?
I actually think it was DriveWealth who sits underneath, but it was just some sort of nonsense misreporting type of something. Here we go.
Because they were reporting the fractionals. What was it like?
They were reporting fractional trades as whole shares.
Yeah.
So if you were buying $10 of the A share, they were reporting it as if you bought an entire share.
So you had kids on Robinhood trading Berkshire A shares for some reason.
It's called the rounding up rule, which is
maybe there was a meme, and they were saying like this is a full share of Berkshire trading when it was
these are the numbers. Because the A shares are so expensive, obviously they've been thinly traded. So from 2019 and 2020, just 359, not 1,000, 359 on average a day were traded. Okay, so that's $100-ish million worth of daily trading. In mid-February 2021, and basically since then, they were reporting daily average volume of 1,900, which is, I don't know, a lot higher than 359, or $800 million a day. So an 8x a day based on just fake news.
So we solved the mystery. Shannon, so we're going to talk about like what you're telling investors now. I think that's what our listeners definitely want to hear. So I asked, like, joking around, what are your best ideas for the second half? But like, what are your ideas about the second half? I think everyone knows where I stand at this point, and they're probably sick of hearing about it. But what are you saying to people that ask you, which probably happens, I don't know, once an hour, 5 days a week? Okay. Yeah. All right. So what are you telling people?
So, I mean, the biggest question I get is, why do you still own technology? And that's the one I've been getting for a year, right? Because I have a bunch of tech stocks in my portfolio. And also, when does this kind of cyclical, boom in things like energy, when does that reverse? And finally, growth versus value. And the third one is where I start. I'm like, this is the most ridiculous thing that we still have to talk about, because
growth versus value.
Growth versus value. And so for me, that's a constant moving target. Like,
wait, why is it ridiculous? It's ridiculous to me because nobody's being forced to make that choice. Is that why it's ridiculous to you?
Well, in some ways, but I don't think you should put it in terms of a binary choice, because that universe changes over and over again, and there's constant resetting. I mean, right now is Netflix a growth stock or is it a value stock?
How about in the Russell, you could be both?
Right in the middle. You can sit squarely in both the Russell 1000
Yeah.
growth and the Russell 1000 value. You can be in both of those. And so how do you square that?
Right.
One of the things that I continue to look at is the expression of technology across someone's portfolio. So I think similar to the Industrial Revolution, that we are in this over the last 20 to 30 years. Whether you believe that technology is deflationary or not, I'm not going to get into that argument here. There's plenty of people who make a lot more money than I do that will say it is. Yeah. But I think one of the things that I look at is technology isn't going away, and actually technology helps to solve some of these challenges that we talked about in terms of the inflationary environment, in terms of labor needs, in terms of being able to keep prices from continuing to rise over time if inputs are coming in. And so things like reshoring of production here in the United States, I don't think we reshore the type of production that we had here in the United States in the 70s and 80s, because that was an efficient production. And we went overseas because we had to get lower wages and make that more efficient for margins to increase. But I think if you bring that back on shore—
It's robots now.
Right. Or it's robots with a human complement, because we don't have enough humans to do things like welding, for instance. So you need a robot. So hardware as a service.
It's not Michael Keaton building Japanese cars in the Midwest,
right?
Like with Teamsters,
no,
with unions. That's not what we're talking about.
Right. No, what we're talking about is in your business over the course of the next 10 years, if you're not putting meaningful capital expenditure into creating more efficient technology and a different way to deliver your product. So my second half ideas are centered around what companies across the market are thinking about technology, not just from an enterprise spending perspective and not just putting in one of those hot, cool SaaS stocks that we talked about earlier, but which ones are looking at their business and going, okay, we have to spend the next several years putting technology throughout our entire process to make us more efficient so that we can get back to the margins that we had in 2019.
So we could reshore, but not have worse margins because of it.
Correct.
Okay.
And so
just buy the robot ETF is what you're telling people?
Just robots. It's just need robots.
I'm super bullish on automation. I just don't know about robots being the trade.
No, not necessarily.
What companies
robots.
are you talking about?
So like someone like a Rockwell Automation, right? That is a great example of the combination of like a true industrial stock, but that can help other businesses do well. Or even thinking about the traditional big tech stocks. I mean, being able to capitalize on what a Salesforce in their CRM system. CRMs are not just for financial services people to be able to log in when somebody called you. I mean, it can be, to your point, Josh, it's the new version of just in time. Right. It's creating that efficiency across the entire supply chain. And some of that has to come back on shore so that we don't have these disruptions. But it has to be done better than it was historically. And the problem is that a lot of these companies, whether they're in true manufacturing or whether they're in some sort of end-to-end product, hardware as a service, for instance, they're not accustomed to having to look at these businesses and get really efficient and really tight and really lean. And so any company that can help other companies or other sectors and industries become that, I think is the huge opportunity over the next couple of years. I'm so tired of hearing about, well, enterprise spending is going to go down. How? How are you going to make your margins without—
and it never does.
It doesn't go down because you cannot make your margins without looking at your overall enterprise and incorporating technology into whatever you're doing.
Enterprise spending is not just something you do when you're bullish. It's something that you do when you're bearish also, because it's how you save your ass.
So the growth can slow, but the revenue's not going down. It's not going backwards.
Right. And
what would have to happen for Salesforce to show negative revenue?
Somebody would have to have a competing product that they're giving away, subsidized by a high stock price.
Yeah, and they don't have, and they would be so far behind on the land and expand. It's not just Salesforce. It's a lot of these different chassis that are set up to be incredibly flexible for multiple different types of businesses. I think a lot of the problems that we've had with the high-flying, high valuation stocks is that they either had no moat whatsoever, so no real competitive advantage, or they weren't able to grow their footprint once they get in the door. I mean, you want a company that can grow its tentacles. Why do you think IBM was such a great company for so long in terms of they would get in there, they get their hardware in there, then they get the consulting contracts, then they get the service contract. Like that's it's the blob effect. And so I'm looking at that, but across different sectors and thinking about who's going to benefit from that, much more than thinking about who's going to benefit from input costs continuing to be really high. Because otherwise, you just buy a portfolio of commodities and just say, hey, listen, I don't think we're ever going back to 2019 values.
So this is, who put the Morgan Stanley thing in there?
I did.
Okay.
So is that sort of similar to what Shannon's talking about? Morgan Stanley said, in an inflationary world, we believe companies that have developed deflationary products and services will become increasingly valuable.
Yeah, that's what she's saying.
Absolutely. Yeah. And again, I think that
let's go through these.
Yeah.
Look over there, Josh.
So we have developed
Salesforce is on here.
A global shopping list of overweight rated stocks that provide such. So these are companies that provide deflation to their given segment. So Salesforce is in here, right? ServiceNow,
XPO, distribution.
Teradyne,
Snowflake, Microsoft.
Oh, so they have Cheniere in here in the clean and alternative energy. I almost pulled the trigger on Cheniere today. I think I'm going to end up buying that stock at some point.
That's really interesting. It's interesting business.
I was talking to Brenda about it. I don't like the technicals of it, but I love it for the second half because I think it's going to be an energy related showdown. And like 3/4 of their energy deliveries were to Europe in the first half of this year.
LNG looks good.
Does it look good?
Yeah,
though?
it does.
But look at these lower highs.
No. It's coming out. It's going to
come out of that,
I
right?
think so. Looks good.
So at 150, if this breaks 150, this could go to like 200, no problem. 150 seems to be resistance. Anyway, who else is on here? I don't even know half these stocks. Autodesk, I know. Microsoft. But this idea that like people are going to have to spend regardless, but they're going to be spending on making this onshoring thing more palatable for profit margins, I think is powerful.
And I don't just, I mean, I know we're taking this in the context of manufacturing, but I think that there are, within the services industry too, there's an opportunity to create some deflation in terms of, the delivery of services. Where I think the challenge will be in places like leisure and hospitality. I don't know how those companies are going to be able, with the amount of the percentage of their costs that are associated with labor, and that labor needs to be well paid to deliver an experience. Like I worry more about the margins for those, because at some point you will hit a maximum. You're staying in a hotel, they're charging you this room rate. There's no room service. That can't go on forever.
Eventually, the demand for that will just go away.
We've got Snap reporting a little bit, but Seagate missed EPS forecast by 16% and lowered next quarter's forecast by 38%.
With no warning, they just straight up missed by 16%. Seagate
sink.
matter.
Let that
it's not really.
sink in.
It's such like a weird corner of tech. These stocks trade like 8 times earnings.
It's the when you have to have a tech stock in your portfolio, but you can only pay a certain multiple.
Right. That's like for a value tech manager.
Super value, like deep value.
The 5 deep value tech managers that exist.
They're still around.
Snap's not out yet.
But Snap's gonna be interesting because they are global ad.
Snap is down. I was looking at it today. Snap is down 87% from its high.
What?
I almost just bought it for that.
Do you think that's justified? I don't find that to be justified
it's outrageous.
at all. I think it's crazy.
The problem is it's still a $26 billion market cap, and they're actually the only social media company that's worse at monetizing than Twitter.
I think they have less revenue than Twitter. We talked about this recently.
They have more users, less revenue.
How?
Because they suck. No, somebody gave us
They suck less than they used to, though.
Somebody gave us the reason. It's because the
Eric
way...
Jackson, I think.
Maybe. No, Kantrowitz.
Wasn't it just last week?
Alex.
Okay.
Yeah, the way users use Snap, they don't go to the part of Snap where ads are shown. They use it to message their friends. They're not as interested in the content.
You got to slide over to the story part, and it's not in your face and not required. Honestly,
and it's not good content either. And no, there's not enough time in the day for that. Right.
Yeah, you got to prioritize your content.
Let's do this. SPACs are dead thing.
Yeah, they're dead.
We know.
Oh, here. Snap's out.
Okay.
Snap revenue a little bit light. Says Q3 revenue flat year over year, not providing guidance. Great.
Good night.
See ya.
Good
luck.
It'll double tomorrow. What do we do, Mike?
Down 16%.
What are we doing with this?
Down 16.
That's mine.
This is you.
Yeah,
okay.
this is me.
Guys, Snap 16.
Down 16%.
Down 16.
Yeah.
Nice.
It was up 6% during the day today.
Down
Yeah,
16%.
5.5 or so.
Nasdaq selling off on that. That's pretty bad. All right, Shannon, what's up?
Yeah. So can we talk about? I want to talk about the SPAC IPO M&A thing, and how does that play out? Because I heard you mentioned it earlier in the show. We were talking about all this like cheap debt, right? LBOs, great, tons of M&A activity. Put
it to work. Let's go.
Yeah, but do you buy this? So if you think about SPACs are, would you argue with me that SPACs are dead?
Mm-mm.
Oh no! Now the lawsuits. Now the SEC lawsuits are about to begin.
Because
there's shit people did 2 years ago is going to come home to roost now.
There are still consultants out there who think this model is going to come back, and I just think the investing public has had it with the SPAC model in terms of like the lack of transparency.
It comes back every 15 years.
Right. So for the foreseeable future, when I hope that we're sitting here talking to each other, it's dead.
Yeah.
IPO volume down 50% in the first half of this year. Revenues down 60%, according to EY.
I mean, but just think
Feels
about
worse.
think about the comps though. This is comping to first half 2021 was insane. It was a carnival.
But look at the Americas, which is basically the U.S.
Yeah.
That's why you think it feels worse, because it's down 95%.
So
in the U.S.
So hold on. So at this point in 2021, there were 287 IPOs, and now there were 77 this year.
It's down 95%. The proceeds. Holy shit.
So IPOs in the first half of 2021 were 95 billion. They're 5 billion this year.
I thought this
might as well
data
be
was
zero.
insane. I
Market
thought it was
zero.
insane.
Market 8, dude.
But that's why you think it's worse,
That
right?
is insane.
Because it's so much better
Over the
outside of the
line.
earnings
Sorry.
from a percentage perspective.
The number of IPO, like in any way you measure it, it's crazy.
Wow.
It's crazy bad. So my view is that this doesn't come back, but I would be interested in your view on where does M&A activity, despite the fact that debt's more expensive, do we use cash? Do we use cash to finance M&A? And does all this dry powder that's sitting around, sloshing around in the VC PE universe, how much longer does that take to come out?
Well, maybe this will help answer your question on whether or not these CEOs are just ducking for cover because they can. Because if they were just bullshitting, then you would expect them to maybe start putting that money to work. If they don't put the money to work.
Can I tell you, they're not going to put money to work, and I'll tell you why. We know this. The historical data is clear that M&A is pro-cyclical.
The most.
It's supposed to be counter-cyclical.
More than buybacks.
And opportunistic.
Yeah.
It looks exactly like buybacks. Yeah. People have the biggest appetite to do the biggest deals at the top of the market.
Always.
So here's data from, this is PricewaterhouseCoopers. $3.7 trillion is the number of cash and equivalents held by S&P 500 companies as of the end of 21. I do believe they'll use it to keep up the buybacks, but that's about it. $948 billion in cash held by PE firms as quote
20. Sorry.
Dry powder. PE firms might use it because it's use it or lose it.
Well, they're
in
using
the PE world.
Yeah, I mean, my view is that I'm hearing a lot about this incredible opportunity to buy cash-rich companies, cash-rich public companies, because they're going to use it for M&A. We know that that's not the case. Does the flip side of that become
the targets?
Yeah, by the targets.
Who are the targets, though? If nobody trusts each other's 2023 outlook, then who are the targets? What CEO wants to blow a hole in their own balance sheet based on someone else's guidance? None.
At this juncture.
It's too soon. So I don't think you'll see it. I could be dead wrong.
Why
are there 35 automakers all trading at 8 times earnings and one of them trading at 50 times earnings? Why does that exist?
Hey, tell me if one of these things are not like the others. So key points on CNBC's website about Snap. Snap missed on the top and bottom line in its second quarter earnings report.
Duncan, I told you he was going hard on Snap.
Snap said it plans to substantially slow our rate of hiring as well as the rate of operating expense growth. And third, finally, the company authorized a stock repurchasing program of up to $500 million. They're not going to do it.
No.
But they authorized it, and that's what counts.
Hey, this is the ultimate, wink emoji.
Okay,
Yeah, it's authorized.
So I guess my question on the if we're not going to see M&A, huge missed opportunity.
Yes,
it always is.
Always is. But It's also a huge missed opportunity that people don't want to put their money in PE and VC in this type of environment either. And that's, I think, even a bigger missed opportunity for investors in this environment.
Say more.
Because there's two things that are happening, right? Less competition to buy things, and more scrutiny on what they're buying. So I actually think that it's not only being willing to buy and having the powder to buy, point. But there's a bunch of companies that are going out for additional term sheets, right? Mm-hmm. Haircuts 50, 60, 70, 80%. So if I'm running a fund, what I'm thinking is, okay, I've got some powder. To Josh's point, it's use it or lose it, right? No one's giving any money back, correct? If we're in the investment period. But I know for a fact that this 2-year period, because I've had such a bad 3 or 4 years before this in terms of the deals that I found, I think that this creates this crop of meaningfully better targets because of the additional due diligence. And because, to your point, they're going to put their best people on these deals because there aren't as many being done right now. So I would say that's even more emphasis.
This is the hardest thing in the world to do because of the agency problem.
We all put back.
Getting aggressive now looks crazy to your LPs.
No public companies are contrarians in a bear market.
Buffett.
Fine.
He's buying this Occidental Petroleum.
Okay, fine.
Like he's buying it like I've never seen him buy a stock in a long time. Is he 20% yet?
I think it was 19 last time.
Yeah, I don't think he was quite 20.
He's buying that stock daily.
Facebook down 5, Google down 3. Snap's down.
On Snap.
Yeah, Snap's down
Contagion.
Snap's down 23.
I think TikTok is eating everybody's lunch in global ad market online, and now Apple's going to start running ads. Good luck. If Apple builds an ad business like Amazon did 3 years ago, good luck Snapchat. Good luck competing with Apple for placement on people's iPhones.
What do you think about Facebook? What do you think about Meta? How do you guys see that playing out?
Personally, I think it's cheap for a reason.
Do you?
Yeah, I think it's cheap for a reason.
I'd rather be a buyer than seller.
I don't want to short it. I definitely don't want to short it, but I think it's cheap. Everyone's like, it's so cheap. Yeah, there's always a good reason for things being cheap, but there's a really good reason.
But do you think that this whole this complete washout from a crypto perspective, NFTs, do you think this whole narrative around the metaverse, how long is that in the penalty box? 2 years?
We'll find out real soon, because if they're still burning, what was it last quarter? Was it $10 billion last quarter?
But that's not even the problem. Throw the metaverse out. What iOS changes did to their business model all over the world is the real problem, and that's why it's 16 times earnings.
Okay,
Nobody gives a shit about the metaverse.
You're right. Fair. Actually, 100% correct. Stock's down 60% from its all-time highs.
Okay. I'm not saying none of that's priced in. I'm saying what changes that? Does Apple say just kidding? You understand?
When's the last time do you think if you look at, and I would say never. When's the last time that stock traded the way that it should based on the revenues that it engineers from advertising? Because I would say that the constant going from one issue for Meta after another has never allowed
of one issue to the
Dude,
next.
She left. Why am I the only person that gets this? She left. Why would she leave? She's the smartest person. She's not only the smartest person in the room at Facebook. Street smart, not Zuckerberg smart. Not only she is the smartest person there, she's the smartest person in most rooms she walks into. She left. She's gone. She sees it. Everybody f***ing sees it. That's the stock price sees it. Pointing to an earnings multiple on Facebook tells me that you never understood what drove Facebook to begin with. What always drove Facebook was not the valuation, right? And I always said this about Facebook. People are like, oh, I would buy it, but it's expensive. It's like, dude, when that thing is cheap, you ain't going to want to own it, because that means the Roman Empire is falling down. So that company is in huge trouble on the Instagram front, and Instagram is all it has.
No, I hope it gets killed on earnings. I'm sorry. No, I hope, not to be Schadenfreude on Facebook holders, but who likes that company? Come on.
Well,
nobody.
But that's the thing. Nobody does.
It's Yahoo.
Yeah.
Come on. Just say it. It's Yahoo.
Well, it's evil Yahoo.
But that's where it is now competitively. It's defending itself on all fronts. It's literally at this point.
It's just under assault by
It
TikTok.
used to be assaulting everybody.
Right.
It was eating into everyone else. Right. Now it's the thing that everyone else is attacking, and skillfully, I might add. They're losing to Snap on messaging with young people. They're losing to TikTok on time spent on the app and any other metric, engagement, blah, blah, blah. They're fighting on all fronts. They're fighting. And they never really had to this extent. And she left.
So what's going to happen in this space, right? We're talking about this contagion, and you're saying like there's not enough eyes on these apps. There's not enough in looking at the stories. The content's not very good. So do we get further consolidation? Because from my perspective, the FTC is never going to approve another.
It takes so long. That's such a great
purchase.
question. It takes so long for that process to play out.
From who? From Facebook? Another Facebook purchase? They've bought everyone.
But they're not going to be able to buy anyone anymore.
No, they can't.
Right.
Buy anybody.
And so what's the end game for a Snap? What's the end game for Twitter? We're going to talk about it, right?
I think Microsoft is going to buy Netflix. I think like we're going to see,
and they'll be able to do that.
Well, yeah, they're the only one of the FANGs that could buy something because they don't have any.
They
media
don't have
properties.
any.
Yeah, and they've never had a problem doing a deal. Like Microsoft fought their antitrust battles 25 years ago.
Yeah.
I don't know what the ownership looks like, but I feel like Reed Hastings is not going to be like, yeah, buy us, we're done.
No, it takes forever. It's a 5-year process of just rationalizing multiples.
Twitter is such a joke. The product sucks. In terms of like monetizing it, the promoted tweets are so out of touch. The shit that I see in my stream, I'm on that app for 19 hours a day for 10 years. They have no idea who I am. None.
So all right. So
then what's the end game for owning one of these? What's the end game for owning Snap or Twitter?
Hope.
Right.
Oh, well, Snap.
Snap has huge engagement.
Yeah, just hoping they can figure
just
it
not
out.
that profitable.
Twitter seems hopeless at this point. With the board, and who wants to get involved with that nonsense?
I think we're gonna skip ahead to favorites because otherwise we've been keeping you for way too long in a room with no air
I thought we
conditioning.
just started.
We could go on forever. Let's do favorites. Michael, we're gonna start with you this week.
Okay.
Everything.
No. I didn't want to tease. It was for myself.
Everything bagels?
No. I do love everything bagels.
Okay.
Last night I saw a movie, and it was like a top 10. Holy shit! I wish I was in the theaters for this movies. I watched everything, everywhere, all at once. Have either of you seen that?
Is that the Korean one?
Yes.
Okay. I didn't see it.
It's based on a Chinese family.
Chinese. Okay. I didn't see it.
Either of you, gentlemen?
I haven't seen it.
Okay.
I haven't seen it.
So it was, you have to bow down to the creativity, the scenes, it was epic.
It's a woman in the multiverse.
It was beyond impressive and epic.
Really?
And
What is it on?
I bought it. I rented it for like $5 on Amazon. It was not necessarily my cup of tea. Like, I think I didn't love it, but I respect the shit out of it, and it is absolutely worth seeing because it's an experience. But damn it, if I saw it in the theater, I would have walked out and be like, that was fucking crazy.
Is it subtitles?
Mixed.
Okay.
It was.
You understand what's going on though?
It was something. It was a spectacle. You know, they said Endgame was like the most ambitious crossover. This was the most ambitious, audacious movie I think I've ever seen.
Wow.
Really?
That's a bold
It
statement.
was wild. Not my favorite movie. Not even like I didn't love it.
Right.
But holy shit, was it something?
But you were glad to have seen it.
It's gonna win awards for like best cinematography or something, stuff like that.
Wait, you're saying you're glad you didn't see it in the theater?
No. It was my biggest. I should have seen that in the theater.
Oh, got you. It would have been even better in the
Yeah.
theater.
But
Okay.
wouldn't it have been something that you would have seen in the theater?
I definitely would have seen this in the theater. I just missed it. It would have blown my mind if I saw it in the theater.
I think when it came out, people weren't in theaters yet, right?
No.
Wasn't it like a year ago?
It was April.
Oh, okay.
Yeah.
So you could have theoretically
I
seen
just
it in the
missed
theater.
it. But it's so again not my favorite. Not even close. I'm not even sure that I loved it. But it's worth. Actually, I didn't love it. But it's worth watching.
So I know you just came back from Italy, and we talked about that before.
Yeah.
Is that your favorite, or you got something else?
So I do have something else. So I had the opportunity to see an incredible poet that was honored at an event last weekend.
Are you trying to say you went to a rap concert?
No, so you'll like this.
An actual poet.
An actual poet, Sonia Sanchez, leader of the Black Arts Movement. Her poetry.
Sonia Sanchez.
Yeah, collected poems. That's a great book. had the opportunity to see her poems are meant to be like performed and read. Yeah. So she's, I think, 87. I saw her perform one of her poems live last weekend, and I'm captivated now. No, I never read anything from her prior to this. I'm actually not a huge poetry person.
How did this happen? Backstory, please.
Yeah, so there's a group, the McDowell Group, up in New Hampshire, and they essentially allow artists to come and stay on property and work in their studios, film, writing, music, architecture, and every year they honor somebody. So, like, you know, past honorees, like people like Toni Morrison, like last year was Rosanna Cash. It's an incredible group of people. So she was the medalist this year, and I went to the ceremony. And I had no idea that she was going to perform one of the poems.
Okay.
And now I can't put the book down.
Why? So what is it that struck you to this degree? Was it the reaction of the people around you to the performance, or was it like really your own?
It was the gripping reality of the way that she writes. Like there are haikus in there, and that you read the words, and like just every single syllable speaks to you. Probably, I mean, not dissimilar to rap, right? You know, you get that incredible emotion. But I think given her history, because they went through her entire history of what she had done in education, she was an educator, she was a writer, and having that context and then hearing her perform, like I just feel like now when I'm reading the poems, it's incredible.
That happens to me sometimes when I go to. So I like visual art. When I go to a museum exhibit, and there's a huge difference if I had read a lot about the exhibit and the artist before I go, versus just going in cold, knowing nothing. I often don't get it. Like it won't resonate with me if I have no idea why it's important or why it was like a big movement within whatever. So like I definitely understand what you mean. So having the history and the backstory. And then the performance.
Yeah, I mean, like, if you pick this book up, like, read her story and read what she's done and her life experience, and then read the poems because they speak to you in such a different way. And yes, I loved Italy. Amazing. I know. Don't be scared. Everyone's going to tell you it's going to be super crowded if you're there.
I'm a New Yorker. I don't give a shit.
No, I mean, just in general for the listeners, like, you'll hear, you know, it's crazy. Europe. Travel was better there than it is here, and it was incredible to be out. And Italians are amazing in terms of making you feel.
So this is a good time to tell the audience we will not have a show for the next 2 weeks.
Oh, that's right.
There will be no Compound and Friends for the next 2 weeks, as I will be traveling extensively in Italy. I won't be there for 2 weeks, but we are on a 2 week 2 week hiatus.
That's
okay.
Right.
But we have what are your thoughts on Tuesday?
We're still doing What Are Your Thoughts Tuesday.
And,
and Animal Spirits is still going, right?
Oh, we never stop.
Okay. So this show is on hiatus for 2 weeks, but plenty of content. All right. I'll do my favorites real quick and we'll get out of here. I watched back-to-back Bill Burr's new special on Netflix, Live at Red Rocks. Was the greatest thing I've ever seen him do.
Really?
Oh, my God. He's getting better. He's like scary good now. I'm telling you.
I watched it.
You didn't like it as much? Were you on the phone while you were watching it?
No. I was on my couch. No, I think he's excellent.
He's always
But
good.
I actually think he might be getting overrated. And that's no disrespect to him. It's just his status is elevated, I think, to an unfair level. He's not Chappelle.
I don't listen to his podcast because he's working out jokes and rambling, and I don't have time for that. This was like...
His material was strong.
This was like strong Bill Burr material, and just... He was... Every joke worked for me. But then I watched...
don't trust the government.
Yeah. But then I watched Dave Chappelle did...
Next level.
Yeah. So he went back to his alma mater. He went to like a performing arts school in D.C., and they wanted to name the theater after him. But then some of the students revolted, and they were like, he's a homophobe. He's obviously not, or he's transphobic or whatever. And then eventually the student body, I think, voted. And of course, they want to name the theater for him.
No spoilers.
So I won't say any more, but he gave like a kind of an acceptance speech, and it's mostly not comedy. He's almost like Mark Twain.
Yeah, he is Mark Twain.
Like
He's
modern.
He's like, everyone throws this word around, but he really, really, really is a genius.
So you're laughing because of like he might do something with his face, but the things he's saying are like extremely true.
It was a monologue. It wasn't a stand-up special, but and there was obviously like jokes in between, but he's just so beyond.
Yeah. Anyway, loved it. I wanted to share a sleeping hack really quickly also that I've discovered. So I've talked about sleep apnea on the show before and snoring and all this shit. It turns out books on tape, specifically A Tale of Two Cities, it is the most boring, like literally.
So boring.
I cannot. So this is narrated by a British guy. It's just this horrifically bad, boring story.
Is this Chas Dickens?
This is Charles, and I like Dickens, but listen to me. Audible, A Tale of Two Cities. Put it on. No phone. Like put it on and put the phone next to you.
Out.
Use headphones, and you will wake up with the imprint of the headphone. And that's how hard you will fall asleep. You don't need Ambien. You don't need Xanax. You don't need alcohol. You don't need, what's that other shit, the gummies? What do people take?
Weed.
No.
CBD?
Melatonin. You don't need any of it. You need A Tale of Two Cities on Audible. I'm telling you, it's lights out, and actually, you will sleep through the night. Like, get into this habit. And the good news is, you can go back to the beginning of the book. If you get through the whole thing, which you can't.
It's pretty long.
You definitely can't. But if you do, just go back to the beginning, and it'll knock you right back out. All right, that's all I got for favorites. Shannon, we love you so much. Thank you so much for coming back. We want to have you on a regular basis. Is that okay?
That's fine with me.
Can we get you back here?
Absolutely.
This is
Okay.
great. Thank you.
Fan favorite. The audience loves you. Your star on CNBC. You are killing it at...
Thanks to you, my friend.
No. Not thanks to me. Thanks to you. You did it. You are killing it at your new role, CIO. You're a big celebrity. And you're coming to Future Proof.
Absolutely.
I gotta find. So now that I know you're coming, I gotta find something for you to do there. I can't just have you milling around like a civilian.
Having fun? Please.
All right, come on. All right, Shannon Saccocia, ladies and gentlemen, round of applause. Thank you so much for coming.
Thank you.
Duncan, any announcements before we go?
I've got a review.
Let's do a review.
Okay. So Perry Masterflex wrote edifying.
It's his real name.
Edifying. First time, long time. Excellent podcast. Must listen. I too learned to ride a bike in the Merrick Jewish Center parking lot.
Boom. This guy really listens.
Yeah. And then last one. I'm bullish on this podcast. Excellent show. And Josh reminds me of Vinny from The Big Short. Keep it up.
Is that good? Vinny from the who's
I think
Vinny
so.
from the Big Short?
He's from Succession. He's a Kindle, right?
Oh.
Word.
Isn't he that actor? Jeremy Strong?
Yeah. We're gonna have all of the real life people that were in The Big Short are coming to Future Proof to do Dan Nathan's podcast.
Oh, really? Oh, cool.
That'll
So
be
I
fun.
think so on the tape podcast, friends of ours,
Oh, Danny Moses.
he's gonna get like all of the other people that it was based
Not
on.
Bari.
No, definitely not. So anyway, all right. So you're gonna be at Future Proof. Thank you for the reviews, guys. Keep the reviews coming. We appreciate them. They mean so much to us. They help the show. If you like what we're doing and you're learning something each week and you're having fun with us, go ahead, 5-star the shit out of the show. Write something as a review, and we will love you forever. Okay, thanks for listening. We will be back, not next week, and not the week after, but the week after that. It's on. In the meanwhile, Animal Spirits is still going. We got you covered. Great job, everybody. Nicole, John, Duncan, and we are out. Take us out.